And we are fortunate to have PricewaterhouseCoopers industry experts Bob Singh, Greg Garland, and Mel Machado with us today to share their perspectives on the current SR&Ed program and the importance of the project description in ensuring an effective SR&Ed filing. Joining us on the call, we have Andre Halado from IntelliJoint Surgical, Chris Shaw from Bayless, Glyn Jones from V-Light, Rob Hall from HTX, Yervant Terzian from Shift Health Paradigms Limited, Owen Roberts from NobleX Biotech, Steve Fanjoy from Devera Logic, Laura Acetola from Amgen Canada, Ray Moisen from Excella, Peng Fu from DRI Capital, Jane Dong from Sense Intelligence, Caitlin Dolan from RBC, Ken Hughes from ITP, Mark Curtis from CCRM, Alice Morby from Gaytronics, Richard Pitto from Codewise Medical, Leanne Goldthorpe from Temperature Technology, Sunny Young from Arctic DX, Richard Baranek from Gaytronics, Andrea Lee from HTX, Raphael Ronan from Sunnybrook Research Institute, Destiny Gardner from Interface Biologics, Jason Kotler from Sonic Vision, Angela Chin from Aterica Inc., Tom Liang from MedButech, Pantea Pervisian from MedButech, Sean Thompson from Amric Development Corp., Anthony Cole from Cloud DX, Zahir Aditya from Curtis Cloud, and I think that's the list. So I'll turn it over to you, Bob.
Great. So if we could go to the agenda. So today, what we thought we would do is go through just a quick summary of some of the changes that have happened over the past year, and just to remind people that the federal 2012 budget proposals are all now in effect, and really in 2014 go forward, we're in a situation where all of those are in effect, and we're going to just quickly summarize the impact. And then we'll move into some other areas just to talk about aspects of issues with respect to SR&Ed, but things that we see as a common thread, if you will, in the context of life sciences and biotech company. And those concepts are, the type of entity that you are for purposes of tax can affect the amount of SR&Ed refundable credits you get. So we're going to talk about the types of entities that are out there. And the other area that also seems to come up as, an unexpected trap sometimes is the concept of associated corporations, again, which is a defined term in the Income Tax Act, which I will outline shortly. And then another area that always seems to be of, specific importance to this sector is the treatment of government assistance programs, and there's been some case law developments over the last year that are relevant, and so we need to make sure that companies that are members of OBIO and other life sciences organizations across the country, that you be aware of some of these issues that can come up and what's happening out there with respect to other programs in other provinces. And then the other important aspect of today, which Greg will speak to, is the concepts of just the very important aspects of what needs to be in the project descriptions that support the work that the claimants are doing with respect to scientific research and experimental development. And then lastly, we will outline some common experiences we've seen on the audit side of the equation. And then finally, we'll wrap up with some questions from the group. So why don't I quickly go over some of the changes that have come into play just to remind everyone, and I'm sure some of these are familiar to you, but I think it's just quickly important to talk about them at a high level, and then I'll tie them back for you in the context of some of those issues when we get into the types of entities and associated corporations. So quickly, federal program changes. That the main change that's happened is for non-CCPCs, effectively the investment tax credit rate has changed from 20% to 15%. However, for qualifying Canadian-controlled private corporations, i.e. CCPCs, the 35% refundable tax credit is still available provided you meet the size tests on both a taxable income basis and a taxable capital basis. So effectively, if your taxable income is less than $800,000 on an associated group basis and your taxable capital is less than $50 million, then you still have an opportunity for refundable credits. You may not get the entire amount, but the point is that that's the threshold, that if you exceed those thresholds, you're into non-refundable credit. So the other main point that out of the federal program is that I just want to remind people that it's on your first $3 million that you're entitled to the enhanced 35% refundable rate. The Ontario programs are still robust in that they have not changed this year. You still have the non-refundable credit of the Ontario Research and Development Tax Credit at 4.5%. The Business Research Institute tax credit is still a very lucrative 20% on your first $20 million of spend with eligible Ontario Research Institutes. So really, if you spend that much money, you can get up to $4 million in refundable credits from Ontario. There is also a third program in Ontario, the Ontario Innovation Tax Credit. Provided you meet the size test, again on a taxable income and taxable capital basis, it is a refundable credit of up to 10% of your SR&Ed qualifying expenditures in Ontario. Some changes have happened in Quebec. We thought it would be relevant for the audience just to be aware of these changes. These changes happened in 2014 in June. And so many people have thought that, the Quebec had offered, very good, tax credits for R&D in Quebec, and they did. They offered a lucrative refundable wage credit at 37.5% for smaller Canadian companies. And basically, when Quebec did a review of its finances, it no longer can support that level of spend. So what it's done is effectively across the board, it's made changes to its programs by reducing all of them by about 20%. And so what that means is that the refundable wage credit, which used to be 37.5% at the max range, is going to be dropped by 20%. And so some of the larger companies, which were used to getting 17.5% for their R&D spend on wages in Quebec, are now going to get 14%. And if you are using contractors in Quebec to do SR&Ed for you, then basically that is going to go from 8.75% down to about 7%. So these are changes we want you to be aware of. The other program, which is similar in concept to the Ontario Business Research Institute tax credit, provided you had the relevant approvals in place, went from 35% down to 28%. So we just want to frame these as the changes that have happened over the last couple of years and are now in effect for 2014. So let's talk about the expenditure side of the equation quickly, and I'm sure a number of you are all aware of this, but again, just to quickly recap, the main changes that have happened are not to labor. Labor is effectively still the most substantial expense for claimants in what we see in this sector, and at the end of the day, there is no change based on the federal 2012 budget. The changes happened really in contract expenditures with third parties and this other group of payments, third-party payments, where a claimant does some work with a university or something like that. The university is the one leading the charge on the R&D development, and at the end of the day, the claimant has access to the intellectual knowledge that's being generated out of that work. So that's referred to third-party payments. So both of those, where you used to be able to get 100%, you're now down to 80%, and that started in 2013. But the key other point that's come in there is that if those costs include any kind of capital cost or capital expenditure, you must carve those out of those types of payments. And why? Because capital expenses by themselves have been now fully eliminated in 2014. So that's a key change that's also happened. So one of the things that claimants need to think about is whether or not any of the materials that they've been claiming or capital that they've been claiming, if they've misclassified those either way in the past, you really need to now scrub that down to make sure you have the correct expenditure. So if it is really a capital item, you've got to carve that out. The other change related to labor is with respect to overhead. So what's happened is in the past they used to give you, currently, there's a shortcut method to estimating your overhead expenditures related to SR&Ed. It's called the proxy method. Previously, you were entitled to 65% of your directly engaged SR&Ed labor. That's now changed, and effectively, if you want to use this shortcut method, you're only entitled to 55% of the SR&Ed labor. So, and that's if you don't want to go through the big headache of doing the traditional method of overhead allocation, which really requires you to carve out the expenditures and go after directly related and incremental SR&Ed expenditures. So more work there. So we wanted to talk about types of entities. And why do we want to talk about that? Well, what we're seeing is that, a lot of companies in this sector are accessing various types of funding. And that funding's coming from the government, that funding's coming from private venture capital, and it's also coming from outside of Canada. So in either form, as private venture capital or direct funding so really we want to remind claimants that the type of entity you are is very important in the context of, well, what refundable rate are you going to get on the federal SR&Ed program? So if you're a qualifying CCPC, so Canadian-controlled private corporation, and you meet the taxable income thresholds less than, if you're $500,000 or less, it's cleaner, but also your taxable capital, if it's less than $10 million, you're looking at the 35% refundable rate on your first $3 million of SR&Ed expenditures. So ideally, this is where a lot of companies want to be. But we're seeing with the introduction of various types of funding, it's not always easy to be a CCPC. So another example of something that can come up is you may be a qualifying CCPC. You may have a situation where on a de jure controlled basis, the investors are, when you look at it at the cap table of the company, you could see that, all of the investors are primarily Canadian. So let's assume they're all over 50%, and you have clearly got voting control in the context of Canadians, as opposed to non-residents or public companies. In that context, that's a starting discussion. However, what we're also starting to see is that investments can be made by non-taxable entities or government agencies. And when they add investments into the equity of the company, then you need to be watching out for the concept of what is an excluded corporation. So an excluded corporation is any corporation where if you look at the investors and greater than 50% of the voting control or de jure control rests with entities that are non-taxable or tax-exempt, then you need to be aware of that concept because the refundable rate can be changed from 35% down to actually only 40% of that 35% that's available to a regular qualifying CCPC. So this is an important aspect that when companies are looking at, investors, they need to be aware of what can happen to the impact on their refundable credits when other investors are coming. And that's clear in the context, obviously, when non-residents are coming into the equation or public, but we also want to remind you that just because a Canadian entity could be coming into the mix, this concept of excluded corporation can affect your refundable credit status, so we just want you to be aware of this type of scenario. The third type of entity is, as I mentioned, this is where you haven't met the qualifying CCPC requirements because you're above the thresholds, or you're clearly not owned by Canadian individuals or corporations, so it's hard to argue that you're a CCPC. As a result, in this circumstance, you're back down to the 15% ITC on a non-refundable basis. Okay, so the next section, to make things more complicated for life sciences and biotech companies, is a concept which is a tax concept defined in the Income Tax Act, and it relates to SR&Ed because associated corporations are required to share that $3 million we've been talking about for the SR&Ed expenditure limit. So if you're a company that is associated with another and you're both carrying on SR&Ed, you both can't get 35% on your first $3 million each. You have to share it. Now, that's pretty basic. I know a lot of people are aware of that rule. However, the association rules in 256 of the Income Tax Act make things very complex, and we're going to go through an example in a second, but the basics are that you're associated with another corporation if that other corporation controls you directly or indirectly in any manner whatsoever. So that wording is fairly broad. And so it's different than the de jure control tests, which talk about legal control. So I want to just point that out, is that and we'll go to an example, and I think actually why don't we do that? It probably helps frame this. So let's imagine a Canadian life sciences company called Corporation A. Assume it has two classes of shares, common, voting, and preferred shares that are not voting. I'm going to make the example so out there that it'll drive home the point first, but then I'll vary the example in a second. So assume two Canadian individuals own 100% of the common shares of the company, and we'll assume those common shares have value of $450,000 based on what's been contributed. And let's also assume a Canadian corporation. And I'm going to say Canadian at this point. It could be non-resident for that matter, but let's just say Canadian corporation owns 100% of the preferred shares. And we'll also assume that the preferred shares have a value of $550,000. So step back from this second. You ask yourself, well, I've got Canadians who own all of the common shares. So that's the voting shares. Looks like I got a CCPC here. I've also got a Canadian corporation. It doesn't own any voting shares. So, okay, so the Canadian individuals own this company. So on a de jure control basis, we can say that we have what appears to be a CCPC. Okay, so that sounds good. We're looking at the 35% refundable credit. However, there's a trap. And so there's a trap in a further section or subsection of 256 of the Income Tax Act that actually requires you to look at the values of the types of shares that are in the outstanding capital of the corporation. So this is the kinds of things that are buried within these rules. And so what happens in this case, based on the facts, if you assume the total value of this company, or at least the capital stock of the company, is $1 million, in this case, that Canadian corporation owns 55% of the value of all outstanding shares. Well, based on the provisions in 256.1.2, there's a rule that says even though you couldn't say that, let's say, Corporation B controls it, we're going to deem it to control it based on the fact that it owns greater than 50% of the fair market value of all issued and outstanding shares. So in this context now, you are required to look at Corporation B and Corporation A in the context of the expenditure limits. You need to look at it in the context of the taxable income, and you need to look at it in the context of the associated group's taxable capital. So notice I said you can have a myriad of changes in the facts, but the point here is that we want people to be aware that as you add classes of shares to your capital stock, there are other rules that can catch you on this associated corporations concept. And the tie back for SR&Ed is the fact that you have to share that $3 million expenditure limit. So the worst case scenario here could be that if you change the facts slightly and say that Corporation B, who in this case, let's say, is a non-resident and it has taxable income in excess of the $500,000, then you can have a situation where at the Ontario level, your OITC or Innovation Tax Credit can get completely wiped out. So it may not affect your federal, but you could still have a problem at Ontario. So we just want to remind claimants that this is an area that needs to be looked at carefully when you're pulling together your SR&Ed claim. So let's move on. And at this point, I want to turn it over to Mel, and he's going to talk about another aspect of problems that we've seen or issues with respect to government assistance. And again, we think it's a relevant concept in the life sciences and biotech sector. So Mel, could you walk us through government assistance, please?
Thank you. So the overhead that you see right now is the definition of government assistance as it is written in the Income Tax Act. So what I want you to also keep in mind is what's in bold that I have put in there, because or any other form of assistance. This makes it very broad, as you will see in the court cases that have been there in the past and the latest one. So it's a key to it, and I can tell you that I was, as Bob mentioned, I was at CRA. I was CRA liaison with Department of Finance and was involved in drafting SR&Ed legislation for well over 10, 12 years. And I was around when this was put in place, and the tax policy was very clear. The government or the Department of Finance felt that if you got paid once by any government, any level of government, then you should not be getting another form of assistance in the form of tax credit. So that's why they made it very clear that they wanted to catch anything that would look or smell like government assistance. So if you go to the next slide, you will see that the case that we want to discuss is the one that just came out in 2014 of the federal court. So what happened in immunovaccine technologies case is the taxpayer received from ACOA, the Atlantic Canada Opportunities Agency, an estimated $3.8 million over a period of 4 years or so to develop a vaccine against infectious diseases. The Canada Revenue Agency considered the funding from ACOA as government assistance and reduced the expenditures of the taxpayer, which in turn would reduce the tax credits that you would be entitled to. Taxpayer, however, felt that it was not a forgivable loan, but a regular loan, and there was no agreement by CRA, so the file was assessed, it was appealed, and the taxpayer then went to the tax court. In the tax court, the judge concluded that the CRA was correct, that it is government assistance, and as a result, they confirmed it, and so Immunovaccine Technologies then appealed to the federal court on the issue that the judge in the lower court had interpreted the definition of government assistance incorrectly, and that it was not a forgivable loan, but it was a regular loan. So they wanted the higher court, the federal court, to intervene and look at the definition. So what happened here was in the federal court, the judge looked at it and concluded, as the lower court, that it was still government assistance, and they gave the following reasons. So the judge adopted the test in CCLC Technologies case. CCLC is a case that had to do with the Alberta government, and that gave some money to a taxpayer. And so in that case, the lower court felt that it was not assistance in the case of CCLC Technologies, but in the federal court, they again overturned that decision and said that it was assistance. So the test there was, do they have an attribute of a commercial venture when they get into these types of agreements? And so the judge felt that is the public authority in question acting in a business rather than in a governance capacity. They concluded that it was not a business venture. It was not a regular loan advanced on reasonable terms for business purposes. So what happened was that in that case, they looked at the regular loan, they looked at whether it was a normal commercial business venture, and concluded it was not, and therefore they concluded in CCLC Technologies it was not a regular loan, it was government assistance. So the judge in this case took the same approach, looked at the decision, and followed the same decision as far as deciding on this case. He also looked at the words of the law, and as I indicated, any other form of assistance in the wording does not restrict the form of assistance he felt. The words are capable of including a variety of forms of assistance included in subsection 127.9. So, in addition, if you go to the next slide, the judge also looked at the agreement and the language in the agreement and felt that the agreement didn't come across as a normal regular loan agreement or a business venture. For example, the agreement contained reporting requirements that immunovaccine technologies had to do to ensure that they spent the money as it was supposed to be spent. The taxpayer was required to pay the contribution back to ECOA, but only to the extent as a percentage of gross income earned. Agreement ends in 2017, whether or not there is a repayment, and that most ECOA will receive in return for its contribution would be without interest, would be the contribution. So, as you can see, the judge felt in this case that it was not a regular loan, but it was assistance. So, a few things to keep in mind is that you need to keep in mind that this is all not lost, because if ever you make a repayment, then the repayment that you make will earn tax credit at the same rate that you had to grind it when you got the assistance. So, in other words, if you were a CCPC when you got it and you lost your 35% because of the grind of the assistance, and 5 years from now you pay and you may not be a CCPC, in those cases your ITC will be given back to you on the repayment but calculated 35% rate. So it's not all lost, but it's a matter of a timing difference. So a few key things to keep in mind is it all comes down to the agreement. Does it look like a normal business venture, or is it not just, or is it assistance? Does it look like a regular loan? Does it have the characteristics of a regular loan? So it's very important that when these agreements are entered into, that these things are kept in mind with the funding agency to ensure that they are either a loan or that they are regular loan, or it's assistance. CRA right now, I can tell you, because of this case and in the past of the other cases, they've taken the tough stand that and based on tax policy that if you get paid once, you're not going to get it again. But if you repay the money, then you will. So they have been consistently assessing any of these funding programs as being assistance. So I'll conclude by saying the agreement that you enter into must be very critical and must be looked at if you are going to get over this government assistance. So over to you, Greg.
Okay, thank you, Mel. The next two topics, before we get into the Q&A portion of the session, concerns the importance of the project description, followed by audit observations. And I'll try and remember to provide a linkage between these two topics along the way, because the project description does have bearing on as an aspect of why projects might be selected for audit. So, the first thing I want to say is that the project description, or the PD, that's submitted with the tax claim, or the claim for the tax credits, it's your first, it's your best, and it's your least expensive opportunity to substantiate that a particular project being claimed is eligible as SR&Ed. So, the first, best practice, I would say, is to avoid just dusting off the prior year submission if you have a continuing project, and then updating it and resubmitting it. And this is especially the case if you've got a history of your SR&Ed tax credit claims being assessed as filed. I really want to emphasize that assessed as filed doesn't mean that the project, that the CRA has, determined it to be eligible. They're just saying they've done a risk assessment and they're not passing judgment. They are assessing it as filed. And I know a number of companies in this sector have, encountered were the subject of audits and were a bit surprised because they've had a long history of assessed as filed. And that's just reflective of the fact that the history does not weigh into a decision on eligibility in a current year that's being audited. So I want to remind, and this is probably well known, but I would want to remind folks that when the CRA are considering that a project is eligible, they are really looking to confirm that the project follows essentially the scientific method. And what I have here is that is an extract from the current policy, and this is the policy that the CRA issued in December of 2012. And they say that a SR&Ed project should have the characteristics of the scientific method, which is, there's a definition of a problem, that there's a hypothesis that has been formulated and put forth to resolve that problem, that there's going to be some planning and testing around how to validate that hypothesis, either through experimentation or analysis of data related to that hypothesis, and the developing some logical conclusions based on the results. So essentially, this is what the CRA are looking for. This is what a SR&Ed project should involve, whether it's science or engineering. This does not exclude, having the scientific method does not exclude engineering projects. A large portion of projects are, development of products and processes with some aspect of engineering involved, but they're still looking for this scientific methodology to underpin the nature of the project. So the people that are writing the project descriptions, they do need to be aware of this and do need to reflect that structure in their response. So for those folks who are on the line that aren't, you may have finance background, or there's other people in your organizations that are writing the project descriptions, the message to those would be, be familiar with the T4088. This is the guide to the preparation of the Form T661. Be familiar with the CRA's policies on eligibility of work for SR&Ed investment tax credits, And this is an online policy. It's no longer available as a downloadable PDF. And also to be aware of the evidence. And I'll come back to the evidence when we go through the audit. But it's very much the case that, and this is part of the CRA's guidance, is that when the PDs are being prepared, they should be prepared with some thought to the evidence that would substantiate what's being claimed. So there's, in the previous page, I've made reference to two sources of information around what should be in the PD. So the first source is the guide to the preparation of the T661, and it's part 2 of that form, which involves the disclosure of the project through the project description. And there's 3 elements to the project description. First element is uncertainty. And the bullets here are essentially a summary of what's in the guide to the T4088. And it's important that when one is preparing the project descriptions to touch on all of these requirements, right? And it may be that what's not, if any of these elements are not being described in the project description, that might be a reason for the CRA to select the project for review. The second important point and point of awareness is the 5-step assessment process that the CRA has adopted since December of 2012. So when the projects are being reviewed, at the time of the assessment, they are being reviewed also with this process in mind. And this process is outlined in the CRA's policy. It's very much driven by some jurisprudence. There was a court case in the late 1990s. It's just commonly referred to as Northwest Hydraulics, and this very much mirrors what the judge stated at the time in terms of how projects should be assessed. These are the features that would be or the attributes of a project that should be there for it to qualify as SR&Ed. So again, the writers should be aware of this. The reason why I want to bring this out, one may be saying, well, if there's already a guide from the CRA in how to prepare a project description, it's interesting that the guide does not mirror exactly the assessment, right? So you're given instructions on how to write a PD, and then the CRA comes in and assesses it, and is looking at this table. And the interesting thing is that, in 3 places within this table, there's reference to the hypothesis. And nowhere in the guide to preparing the project description does it reference that phrase hypothesis. So why is this important? Well, follow the guide, but also be aware of the approach and incorporate the terminology that's in this table into your project descriptions. You want to make certain that there's a hypothesis explicitly stated in the project description, because that's what the CRA will be looking for. The last item on this table references evidence, right? Was there a record of the hypothesis or hypotheses that are being tested, and were the results of those tests maintained as the work progressed? So they will be, in the event your projects are selected for audit, they will very much look for the evidence and how that evidence ties back to what's been disclosed in the project description. So that's, basically it's an awareness of what the CRA are going to be looking for and tailoring your project descriptions to pull out those elements and make certain that they're all described. If they're not described, then, it's not the death knell, but it's certainly one of the factors that may give rise to your project being selected for audit. So, shifting gears a little bit into the audit experience, and we know a number of you may have already encountered this, but for those of you who have not, I would say over the last few years, we would have seen that the request for information that accompanies the very first notification that your projects have been selected for audit are now requesting a lot of information up front. So these requests for information are, I'll use the term, more onerous than in the past. There's looking for increased amount of financial information to be provided, technical information or scientific information, as well as some other business details. And, often they're not explicitly linked to an issue that CRA may have with your claim. And this may be stepping out a little bit, but I would say it's somewhat inconsistent with the Taxpayer Bill of Rights and the Claim Review Manual. The Claim Review Manual is an online document available to, for you to review, but it's the policy and procedures that the CRA auditors should be following in looking at claims. And the first thing it says at the very start says that the RTA, or the Research and Technology Advisor, should explain the review process, the issues that they may have with the claim, and their planned approach to resolve them to the claimant, right? So they should be explaining this to you, and that may or may not be there in the RFI, right? So if they're asking for tons of information but really not saying why they're requesting it, that's one element about how these very extensive RFIs somewhat deviate from the practice. You'll also find out there's a lot of granularity being requested. In addition to the types of information they're looking for, there's a lot of granularity being sought within those information. So, for example, we've seen requests for a very detailed chronology of activities, of all activities on all projects and all people involved. Right, and when you disclose that, they're looking for segregation of the work into various types of activities aligned with the Income Tax Act. So it's something that you may not be aware of, how the CRA look at how they want to see data presented, but they're asking for that. So knowledge of your project plus how the CRA want to see it based on definitions of the Income Tax Act. There are definitely considerations that have to be made in responding to the RFIs. Having said all of this, you've received your RFI, you're wondering how am I going to reply to all of this information within the 30-day time frame that they may give you. If you feel that the RFI is excessive, right? They're not all like this. Some of them might be quite limited and very easy to respond to, and you may have the information at hand. But if your thought is that the RFI is excessive, it is definitely acceptable to first reach out to the CRA, to the Research and Technology Advisor or the financial reviewer who may have sent you the letter. Call them up and talk to them. Find out exactly what their issues are, because it is not unheard of that they may say, well, send me that subset of information and we'll start there, right? And they may find that with a subset of everything that they've asked for, they can come to some conclusion on eligibility, hopefully in your favor, at a much earlier time and with much less effort on your part. So we would just say that this is something you want to consider, and if whether it's yourself or with your SR&Ed advisors, through that process, right? We highly recommend that this be done. Another aspect of what we're seeing in the audit is an expression of a narrow view of eligibility that may be different than what your interpretation of the Income Tax Act and policy is. These are just a couple of examples, but it's something to watch out for. We're seeing it, and it's nothing that can really be, pinned down to here is exactly what's happening. But there's, when you hear comments and when you read into the RFIs, it's something that that is apparent. So, for example, we've seen RFIs that come back and say, okay, describe to us how the work that's been done advances your technology in the identified field of science or technology. So as part of the submission, every project has to be attributable to a field of science or technology, and there's lots of them. But in reality, many projects cross over multiple fields of technology. And that may be the instance here where your project involves some elements of biotechnology, but also you've got some instrumentation, and so there's some engineering, whether it's electrical engineering, sensor development, and the projects are intertwined, right? You may have something to do with material science. So you've got multiple fields of technology in a single shred project. It's efficient to claim it that way, but it's difficult to answer this question when the CRA seems to be focused on limiting your response to the one field of science technology. So something to watch out for. This is, taking that view on what is allowed within a shred project is inconsistent with CRA messaging that has been made at national tax conferences, or, for example, the Hamilton Tax Conference that is done on an annual basis for shred practitioners. When the current form that came out a couple of years ago that restricted the selection of a single field of technology, they explicitly said, a project can have multiple fields. The purpose of that election is just to help identify the right reviewer to come and to review that project, but in no way does it restrict what can be claimed within a shred project. So just something to be aware of. Another example is that certain RTAs have said that they're looking to see that your shred project results in a new technique or methodology to be developed out of it. And that, again, it's not consistent with what headquarters have said about what shred involves. For example, one may have an established technique that is being tried in a new application, and the uncertainty is around that technique. That technique may be known within the constraints of certain parameters. It's being applied where those parameters are different, and the effectiveness of that technique is what's unknown. And the research that's been done results in new knowledge. So if that's the nature of your project, and the RTA implies otherwise, that's a basis for some pushback. And the takeaway from this is that the shred program is it's a compendium of varieties of information. There's the claim review manual. There's the shred policies that are published online. There's past jurisprudence where the judges have made rulings with regards to shred, and they're all integral to the shred program. And we would say, do not hesitate to make reference to those if in the course of an audit you're finding that there's a bit of deviation from those by the individual who's reviewing. Jumping to the third slide, sorry. The point we would like to make here is that what we've observed is once the CRA have issued a assessment in writing, they will issue that, and then they'll give you a period of time to respond to that issuance. Often it's a month. But what we find is in that final month, there's often a mad scramble to find even more information. Sometimes that new evidence is very compelling. But what we find is that despite how compelling that new evidence is, that there is often very difficult to even get the CRA to shift their position. And in part that's due to the momentum that's built into the process. They have deadlines that they're trying to meet, but when it's written, it's not an individual. There's more than one person who's been involved in the assessment, including the RTA's manager. So, to get people to change their view on eligibility, that is an additional hurdle that has to be considered, right? So the best practice there is keep in close contact with the RTA through the course of the audit, and always try and make certain where they are with respect to issuing that written response, because to the extent that you can always provide additional compelling information about the nature of your project that substantiates its shred, do that as early as possible, even if it means providing information in a piecemeal fashion versus trying to get this large compendium of great evidence together and submitting it at one time. So,
and the other thing that I would add to that, Greg, is that if you can work with the RTA, it's better to do it then, because after they've issued their assessment, the next recourse is don't always allow for the easiest, options for the taxpayer. Like, for example, if you do choose to go down the road of filing a notice of objection, we've seen situations where clients file notices of objection and it's been over 2 years before those notices of objection get reviewed. So, again, to reiterate the best practice here, working with the RTA in the early stages of the audit is the best way to get through these situations and minimizing your tie-up of cash flow.
Yeah.
So I think at this point we need to draw to a close. So thank you again for your participation and questions. We really appreciate it, and we're happy to work with you in the future to talk through any issues you may be encountering with the SR&Ed process. So Mel, thank you. Greg, thanks. And thanks again, Gail. We'll talk to you next time.